As we record this on March 5th, the headlines are dominated by the conflict in the Middle East. For many investors, the question isn't just about politics anymore. It's about how these real-time events are going to impact their portfolios and whether the economy can withstand this shock. I'm Chad Chase, Managing Principal and Senior Advisor here at CG Advisors, and with me is Mike Greim, Managing Principal Investments. So Mike, let me get to a few questions that I'm sure our clients are thinking about. As we see this escalating conflict in Iran and oil increasing in price, how do these weigh on the shocks of the traditional economic indicators like unemployment or consumer confidence?
Yeah, Chad, I think that's a great question. And it's important. I think looking at those types of indicators is still important. I think one of the things that is important in times like these is to also take a step back and understand where these types of indicators were prior to the activities that are going on in the Middle East. Fortunately, the overall economic environment was pointing towards resiliency. Overall growth was trending positive. Inflation was trending generally downward, which are positive signs. And now with what's going on in the Middle East, specifically within the Strait of Hormuz, effectively being, a highway for oil, accounting for roughly 20% of the world's oil and natural gas supply being effectively closed, we could expect to see some impacts on inflation ticking a little bit higher. Looked at some reports today. Goldman Sachs had a report out today indicating that expectations would be for inflation to maybe tick up global inflation, so including the U.S. but the rest of the world as well, maybe by 2 to 5 percentage, 0.2 to 0.5 percentage points. So some inflation tick up, but that really kind of also depends on how long this lasts. Is this a couple of weeks, a couple of days, several months? And so we're just going to have to pay attention and see how things go.
Yeah. And when you talk about inflation, I think about energy prices and that sort of thing. When we think about global inflation, are there areas of inflation that it's going to have more of an impact on, obviously with oil, but then how does that affect interest rates?
Yeah, I think we were actually already seeing a little bit of expectations of higher interest rates on the longer end of the yield curve. When we think about things like U.S. Treasuries, we've seen yields tick up a little bit with some expectation of higher inflation. That said, on the shorter end of the curve, we're also still seeing some expectations that the Fed may still cut interest rates, maybe even a couple of times this year. I think from our perspective, they're going to have to kind of pause and see what happens here. Typically speaking, the Fed likes to look through oil prices as a reason for inflation, as those tend to be cyclical in nature, something that kind of comes and goes. We've seen oil prices in the 80s recently, so this isn't really new. It's not as big of a shock. Natural gas prices are probably a little bit larger shock, but not as much here in the US as in other parts of the world. Certain parts of Europe that rely a lot more heavily on natural gas are certainly going to see a little bit more sting, if you will, to their wallet. We're likely to come through this a little bit better off from an inflation perspective than maybe the rest of the world. Again, it kind of depends on how long this goes. So right now, we don't see any reason to be concerned about escalating inflation like we saw a few years ago and quickly rising interest rates. But that's something that we'll certainly want to pay attention to and might cause us to want to look at shorter term bonds as an example.
Right. I think as the over the history of kind of energy, the U.S. has become a little bit more independent than they have if you look 20, 30, 40, even 50 years ago.
So that's true. And we've also become more energy efficient. So our demands on the oil supply are lower than they were, relatively speaking. And that's true globally, but definitely here in the U.S. And so we certainly are going to feel it at the pump a little bit, and we're going to notice it as consumers because it's something that we pay attention to. But that doesn't necessarily mean that all of a sudden we're going to have an issue with the economy.
So when I think of kind of these times, I think about, well, are there portions of the stock market that do well? I guess I'm going to ask you a more broader question. Are there portions of maybe a client's portfolio that might do okay during this period of time?
Yeah, we think it's important to kind of still remember to take a broader view here, thinking in terms of making sure we don't give up on assets that have the opportunity for growth, primarily equities in most clients' portion of their portfolio. So within stocks, there certainly could be types of stocks that can grow better through a higher inflation environment. Think things like energy, potentially industrials, commodity-related companies, metals, other types of materials, could benefit from that. What's interesting is this is happening at the same time that we've had concerns about, an AI bubble or AI causing issues with the rest of the economy. And we've seen some of the higher quality tech companies perform less positive, in many cases pulled back pretty heavily already this year, to where many of those companies also are starting to look more attractive. Maybe it's a little early to just go jumping in, but certainly an opportunity to kind of be taking a step into some of those companies if you don't already own them. Again, staying diversified makes sense, and remembering to have some level of exposure to something that can be a ballast in your portfolio. High quality bonds, should there be a flight to quality, which we've seen a little bit of that as the dollar has started to strengthen again here through this environment. It could certainly be something to help with your portfolio.
Yeah. And I think that also goes back to when we talk to clients about their plan and short-term cash needs, to continue to make sure that those short-term needs from a distribution perspective are really set aside in bonds or money market or short-term type of bonds that can withstand some of this volatility. And then let your long-term portfolio be your long-term portfolio.
I think that's a great point. I mean, and we work with a lot of folks that kind of that bucket strategy makes sense in their situation, where making sure, again, that they have cash available for those near-term needs to ride out some of these bumps that we're going to go through. Volatility is kind of the price we pay for long-term growth in the stock market. You can't have long-term growth without the volatility. You've got to be able to withstand that. And so making sure that your portfolio matches with your plan and can sustain that. Some clients' portfolios don't need the bucket strategy, and that's okay as well. So just kind of, again, this is a good opportunity to take a step back and look at your portfolio, make sure that it does match with what your objectives are for the next couple of years. And then from our perspective, it's a good time to take advantage of one of the age-old tools that we always have in our arsenal, rebalancing.
Right.
So what is rebalancing? Well, it's figuring out a way to buy low and sell high. So, trimming those assets that have maybe risen in price a little bit more than the rest of the portfolio in the short period of time, and rebalancing back to the parts of the portfolio that maybe have not done quite as well. That tends to work pretty well over the long run if repeated in a very consistent, disciplined fashion. So maybe some of those energy stocks that have risen because of oil prices would be a good time to say, well, it'd be a good time to trim some of those potentially, and add those back to other parts of the portfolio.
Well, Mike, I appreciate you joining us today. Those are great insights. I know this time can be overwhelming to some people, but I think we made some good points about hopefully thinking for the long term, and having a diversified portfolio really benefits you through this time. If you have any additional questions, feel free to get in touch with your advisor here at CGN Advisors by emailing them, or feel free to call our office at 785-340-3434. We appreciate you joining us.